Good morning. It's Wednesday, September 18th. I'm ready for the FOMC. I got the crash helmet ready. I got the iced chai tea latte in hand. So getting into the markets here. Overnight, the precious metals traders took a little bit of profits in the overnight session, and it was really a shallow trading session yesterday. Gold traded in a narrow range, about $26.40 before settling down $12.50, just below 2,600 yesterday. Now, silver traded in a 49-cent range and ended the session down about 8.5 cents at 31.05. Again, the market's complacency is obvious, but we expect to have volatility in a highly anticipated trading session. That's why I got the crash helmet ready, and I wish I had a 5-star harness right here on the seat. So for risk management purpose here, the average true range has declined on gold to $32.50. For silver, it's 81 cents. A lot of times when you have volatility come out of the market into a major event, we see a lot of this with like the USDA report and things like that. Grain futures will trade in this very narrow range. A surprise USDA release sends prices limit up, limit down. And I kind of have that inkling where we might see that major surge in price action. So overnight, again, very contained in the markets, anchoring around these whole numbers. December gold up $11.50 at 26.03, about a $15 range, so half the average true range there. December silver unchanged at $30.98, so anchoring right around $31. Where I saw the profit taking take place was when the Asian market opened. We saw copper futures sell off and silver futures followed suit. So copper at 430 up 3 right now, traded down to about 423.80. Silver futures traded down to about 30.69. Again, copper leading a bit of the charge on that silver market. You got October platinum up $1 at 9.83. If you're going to trade it, go to January, which is trading at 9.93, about a $10 premium. So looking at things here, generally when we have this type of volatility in the market and uncertainty where people are going to hinge on every single word that Jerome Powell says, I do not put together a formal plan when it comes to trading, intraday trading in like US equity markets, because oftentimes you cannot put your stop loss in any kind of technically based level, or the whipsaw action is just going to cost you frustration and cost you capital. So it's best to take a step back, eat your popcorn, and watch the movie unfold. So the Federal Open Market Committee has held those Fed fund rates, the target rate at 5.25% to 5.5% since July of 2023. Investors and economists are about to discover the Federal Reserve how they perceive the immediate risk to the economy. So this is really important here. Is the falling employment figures or the potential for continued inflation more important? The Fed's dual mandate controls both of them, but one requires only 25 basis points, the other requires 50 basis points. So we'll see what happens. Additionally, once that headline is released, the 25 or 50, you got to go a little bit deeper here, because the Fed will release the summary of economic projections. It'll be a quarterly update on the dot plot here and the forecast for the US economy, inflation, and interest rates all coming out today. That dot plot will give you where the Fed thinks everything's going, and then they can try and estimate where the terminal rate is. The terminal rate is where the Fed stops cutting rates. We anticipated right around that 3.25 level. Many analysts are higher, many analysts are slightly lower here. So according to the CME's Fed Watch tool today, 65% chance. So the bulk of the people are leaning towards 50 basis points. 35% chance that the Fed are looking at a 25 basis point. If you analyze every single major bank's research reports recently, most of the people that are data dependent type of analysts, they're all calling for 25 basis points. You have people like Nancy Pelosi sending a letter to Jerome Powell, which should not happen. The politics should not play any kind of role in the Fed, warranting 75 basis points. Now, how does that impact and how does that play in his own mind game? Nobody knows right now. So the critical levels that I'm watching for gold and silver, I look at the correlation first on days like today. it's about an 87% correlated market. So we're going to definitely see that movement back and forth. One is going to play a role on the other. The gold-silver ratio has dropped back down to about 84-1 as of this recording, showing a substantial improvement since September 12th. And that was when copper futures broke out of a 6-day consolidation pattern to the upside. That's what shows you that copper is playing also an active role in this market. So silver futures might have some whipsaw action if he comes out with some kind of hard stance on the economy and you see copper futures pull back. So remember, you need a bull market in gold, in copper together in order to get that mother of all explosions in the silver market. Now, I have confidence that gold is going to continue to do its job. Since mid-2022, central banks have purchased and pushed gold up to record highs without any kind of ETF investor and despite the raising of interest rates. Central banks have divested themselves from the implications of U.S. sanctions and U.S. debt by selling off U.S. denominated currency holdings and emerging market currencies in favor of gold. Now, I'm going to tell you the one secret here that a lot of people don't know is that the ETF demand historically for gold, the big participants, the big players, this is where your RIAs come involved. This is where your pension funds and things like that start allocating towards that particular asset class. Does not happen until 1 month after the first interest rate cut, and generally doesn't peak until 6 months later. So that provides the tailwind on gold and potentially pulls forward our 12 to 15 month price objective of $3,000 an ounce. That's the secret right there. Now, if you got any questions, again, don't be a hero in this type of trading environment. Personally, this is when I start to pare back positions. I run different algorithms and spreadsheets discussing what type of volatility is going to impact the particular market that I'm in based on position size, and when I like to pull that all the way back down. Also, on the tactical ranges that I post, you're going to want to look farther out for your buys and sells. Go to tactical level 2 and 3 because of the increased volatility. Don't get caught flat-footed by trying to take a small position in a tight market, a tight trading range with a tight stop when you expect to see volatility explode. So really focus on your trading, your plan, and everything else in implementing it. You got any questions on futures option trading? Give me a call, 312-858-7303. Remember, futures and option trading involves risk of loss and may not be suitable to all investors. Good luck and good trading.